Winmark Corporation was founded in 1988 in Minneapolis, Minnesota. It is a franchising business that buys, sells, trades, and consigns used merchandise donated by individuals in the community. Their 5 franchises include Plato's Closet, Play It Again Sports, Once Upon a Baby, Music Go Round, and Style Encore. They are also involved in middle market equipment leasing. They focus on technology-based assets targeted for larger enterprises. Winmark Corporation also has a small financing operation focused on serving smaller clients. The company's executive chair to the board of directors is John L. Morgan. Brett D. Heffes serves as the company's CEO, assuming the position in 2016. Anthony D. Ishwang is Winmark Corporation's CFO and treasurer. Stephen A. Murphy is the president of franchising, while Stephen C. Zola is the president of Winmark Capital Corporation.
In doing a flux analysis for Winmark Corporation, we found that there were several accounts that had significant changes from the prior year. So we're going to go ahead and go through these accounts and discuss each one a little bit. And we're going to start with the balance sheet accounts first. So the first account we noticed had a significant change was the cash and cash equivalents account. And this decreased by 50% from the prior year. And according to the notes to the financial statement, this was due in part to a repurchase of common stock and also the creation of a restricted cash account. So what we need to do during the audit is make sure that this cash was actually used for the repurchase of the stock, and then also we need to review the bank reconciliations and get cash confirmations from the bank. The next low risk account that we identified was marketable securities, and this account also decreased 50% from the prior year. And according to the financial statement notes, this was due to the sale of securities and realized losses from those sales. So for this account, we'll be concerned with valuation, and we want to make sure that these securities are not overvalued in order to reduce the loss that Winmark realized on these sales. Next, we found that inventory was also a low risk account, and it decreased by 50% from the prior year. And according to the notes, the company reviews the value of its assets for impairment if certain events or changes in circumstances indicate that the carrying amount may not be recoverable. So for this account, we'll be concerned with valuation again, and we want to make sure that if there was any impairment to these assets, that was recorded properly. So for this, we'll inquire with the company as to what their thoughts were for the changes in inventory, and also we will reperform counts of the inventory for ourselves. The next account that we identified was the short-term line of credit, and we consider this a low-risk account. It decreased $18.5 million from the prior year, and according to the financial statement notes, much of the short-term line of credits were reclassified into long-term line of credits. So for this account, we'll be concerned with completeness and rights and obligations. We'll want to make sure that all the liabilities that should be in this account are recorded, and that we do in fact owe these liabilities. So some of the procedures we'll have to do during the audit are to review the documents for each of these liabilities to make sure that the termination date would classify them as short-term, and also send confirmations to the lenders. The next account we identified was short-term note payables, and we identified this as a low-risk account. It increased by almost $2 million from the prior year. For this, we'll be concerned with completeness. We'll want to review the terms of the liability for the credit classification of the note payable, and also send confirmation to the lenders. The next account that we identified is short-term discounted lease rentals. We classified this as a high-risk account. It decreased by 80% from the prior year. Lease receivables and equipment are used as collaterals for loans that Winmark takes out, and the proceeds from discounting are recorded on the balance sheet here. And for this account, we'll be concerned with completeness to make sure that the entire amount of the liability is recorded. The next account that we identified was the long-term line of credit. We identified this as a low-risk account. It increased about $42 million from the prior year, and according to the financial statement notes, this was used to fund the repurchase of common stock. For this account, we'll be concerned with completeness. We'll want to review the termination dates to ensure that this is classified correctly as long-term, and also send confirmations to the lenders. The next account that we identified was a long-term note payable. We consider this a low-risk account. It increased by about $22 million from the prior year. And again, according to financial statements, this was used to fund the repurchase of common stock. And again, we'll be concerned with completeness, and we'll want to review the termination dates to make sure that this is correctly classified as long-term, and also send confirmation to the lenders. The next account that we identified was the long-term discounted lease rentals, and we consider this a high-risk account because of the complexity of it. And this account decreased by about $26,000 from the prior year. And again, like we discussed for the short-term discounted lease rentals, lease receivables and equipment are used as collateral for loans that Winmark takes out, and the proceeds from the discounting are recorded on the balance sheet in this account. And for this, we'll be concerned with completeness. We'll want to make sure that the entire amount of the liability is recorded. The next account that we identified was deferred income taxes, and we consider this a medium risk account. It decreased by 40% from the prior year, and according to the financial statement notes, this was due to the exercise of stock options. And also during 2015, the company adopted new accounting guidance for the presentation of deferred income taxes, so we need to review their Winmark's work papers to make sure that the new guidance is being implemented correctly. The last balance sheet account that we identified was retained earnings, and we identified this as a medium risk account. It decreased by $50 million from the prior year, and according to the 8K, Winmark paid out dividends, so this could explain part of the large change. So we also want to inquire with Winmark about this large change and get their thoughts on this.
Now let's talk about income statement accounts. The first income statement account we realized is having a significant increase using our horizontal flex analysis was leasing expense. It increased $4 million, and the notes to the financial statement said that this increased because of cost of equipment sales. It's a low risk account, and we're going to test occurrence and completeness. So by how we're going to test occurrence is we're going to make sure that those leasing documents, the expenses are going to show up in the current period. And we're also going to test completeness by looking at those leasing documents and make sure that those expenses are showing up in the general ledger. The next account we identified was provisions for credit losses. We identified this as a high-risk account because of its subjectivity nature. This account increased 300% from the prior year and acts as an allowance for losses on lease receivables. For this account, we are concerned with valuation. We need to create a schedule and make sure that it's consistent with what has been used in prior periods. And if anything has changed, we need to inquire to management about it and make sure that it's in accordance with GAAP. The next account that we identified is interest expense because it increased $1.5 million from the prior year. This account is a low risk account, and the notes of the financial statements say that it increased because of the corporate borrowing. So we're going to test completeness and occurrence. We're going to test completeness by looking at the confirmation from the lenders and matching the interest percentage with how much they borrowed and make sure that that matches the interest expense for the period. And we're going to test occurrence and make sure that that interest was accrued properly and that it was recorded in the proper period. Interest and other income or expense is the last income statement account we identified. It decreased from $14,000 of income to $63,700 of expense. The notes of the financial statement said that this was due to the loss on sales of marketable securities. It's identified as a low-risk account. We are concerned with valuation and completeness. Valuation, we should make sure that is consistent with our findings in the marketable securities balance sheet account. And completeness, we should sample the sales of these marketable securities and make sure that they end up in the general ledger. Now we're going to briefly touch on the risk of the entity. We're going to assess control risk as low. So now we're going to talk about other risks. Over 200 of the 900 franchises are going to expire in the next 3 years. This poses a risk to the entity in future periods, but it's not going to necessarily affect the financial statements right now. The supply of merchandise can be extremely risky when it comes to the type of business model Winmark runs. Since the company is a franchise, the company cannot directly control how much inventory is purchased at. It is at the discretion of the franchisee. This can indirectly affect revenues and how much Winmark is receiving through royalties. Also, government regulations can affect how Winmark operates, and fines can be incurred in the financial reporting period. This poses a risk. This poses threats to the current financial statements. Another risk for Winmark Corporation is credit risk. The ability for lessees to pay Winmark through their leasing program can affect the current year's financial statement through the provisions for credit losses. This account should be looked at carefully, as it is a very high risk for the company. Another risk for Winmark is its increased amount of debt. Winmark borrowed a lot of money using a free floating interest rate, LIBOR. This floating interest rate may affect Winmark negatively because of the rising interest rate environment that we are currently in. This could pose solvency issues if interest rates rise. The last major risk of Winmark would be their complex accounting issues. They generate a lot of revenue through leasing and franchising. With leasing, it is very important to determine the difference between a capital and an operating lease. And with franchising, it is very difficult to determine when to recognize income. So these two things should be looked at very carefully when going through the financial statements.
In order to calculate materiality, we used income before taxes because of its steady increase over the past several years. We chose income before taxes over income from continuing operations because it was a smaller figure and therefore more conservative. The acceptable percentage ranges to use for income before taxes is 3 to 10%. We chose a slightly conservative 5% and ended up with a materiality figure of $1,761,240. During our substantive procedures, we plan to pay extra attention to the high-risk accounts we have identified previously. These accounts include both short and long-term discounted lease rentals, as well as the provision for credit losses. In order to account for this high risk, we will perform more extensive testing with more advanced staff. In conclusion, we plan to provide reasonable assurance that the financial statements of Winmark Corporation present fairly as of December 26, 2015.